Hi, everybody. It's time to start talking about Chapter 4. Chapter 4 is a nice continuation of Chapter 3. So let's quickly review what you learned in Chapter 3. In Chapter 3, you learned the rules of debits and credits. You learned that the expanded accounting equation is assets equals liabilities plus owner's equity plus income minus expenses minus draws. And you learn that there is a normal balance for each of those accounts. All asset accounts have a normal debit balance. Liabilities, owner's equity, and income all have normal credit balances. Expenses and draws have debit balances. And we use dead coil as a mnemonic to remember that. In dead, the debits mean that all expense, all asset, and the draws account all have normal debit balances. Therefore, we will increase the account balance if we post a number on the debit or left-hand side of the vertical line. If we want to decrease the balance, we would do the opposite. We would decrease cash with a credit. The CR, or the credits, mean that all owner's equity, income, and liability accounts have a normal credit balance. That means their balances are increased with a credit and decreased with the opposite, a debit. For instance, accounts payable would be increased with a credit and decreased with the opposite sign, decrease accounts payable with a debit. So that's a review of what we've learned so far. We also, in Chapter 3, looked at this transaction analysis and journal entry practice form. And we actually did the analysis for these 3 transactions. So where we're going to pick up in Chapter 4 is to analyze these transactions again and then write a journal entry to record those business transactions. So the first transaction is John Smith invested $15,000 cash to start the business. What 2 accounts are involved? Cash and J. Smith Capital. Once we've identified the accounts involved in the business transaction, then we don't work horizontally, we work vertically. What category of an account is cash? And your choices are asset, liability, equity, income, expense, or draw. Well, cash is a resource that the business will use in the future, so it is an asset. We want to know what the normal balance of cash is. I'm hoping that by now you know, without looking at dead coil, that cash is an asset and therefore has a normal debit balance. You really do need to be there by now. But in case you're not, go ahead and sneak a peek at dead coil. It'll help. All asset accounts have a normal debit balance. Now we need to understand whether the balance in this account increased or decreased. Well, from the business's point of view, the business just received $15,000 in cash, so the balance in cash increased. If we want to increase an asset account with a normal debit balance and like signs add, then we're going to do the same thing to the account as its normal balance. We're going to debit the account. Debit cash to increase its balance. By how much? $15,000. Now that we've finished the analysis with cash, let's do the same analysis with J. Smith Capital. What kind of a category of an account is capital? Well, go down here. It's not an asset, it's not liability, it's not income, expense, or draw. It is an equity account. What's the normal balance in equity? Hopefully you remember by now that it's got a normal credit balance, but let's confirm that by looking at dead coil. Owner's equity have a normal credit balance. Before this business transaction, we didn't have any capital recorded on the books. Now we're going to record some capital on the books, so the balance in capital increases. And how do we get an account with a normal credit balance to increase? Like signs add. We're going to do the same thing as its normal balance. By how much? $15,000. Now that's a review. We did that in the Chapter 3 lecture series. What we didn't do was to write a journal entry for this. And it's very important that you learn how to write journal entries. The analysis tells us that we must debit cash for $15,000 and we must credit capital for $15,000. So the journal entry is written this way. Start out with your debits first. Debit cash, $15,000. And credit capital, J. Smith Capital, for $15,000. Then we need to give a brief description of what happened in this transaction. And frequently it'll be pretty much the same as the business transaction you're given. So we would say something on the order of John Smith invested $15,000 to start the business. Probably ought to be a little formal and put the dollar sign there. So debit cash for $15,000, credit J. Smith Capital for $15,000, and a brief summary of what that business transaction was all about. J. Smith invested $15,000 cash to start the business. Let's go to the next transaction. Paid $1,200 for current month's rent. What accounts are involved? Well, we paid, so we used some cash, and rent expense. Then take them one at a time vertically. Cash, you should know by now, is an asset with a normal debit balance. Does the balance in the account in this transaction increase or decrease? Well, it decreases because we paid cash. We spent some of the money we had. So it decreases. Should we debit or credit the account? Well, if we want to get cash to decrease, we have to do the opposite of its normal balance because like signs add and opposite signs subtract. So we're going to have to credit cash to decrease its balance. By how much? $1,200. Now that we've done the analysis on cash, let's do the analysis on rent expense. Rent expense, it's pretty obvious what category of an account it is. It's an expense account. Let's take a look at dead coil real quickly. Expenses have a normal debit balance. So the normal balance for rent expense is debit. Did the balance increase or decrease? Well, before this business transaction, we didn't have any rent expense on the books. Now we have some rent expense to record on the books, so the balance increases. How do we get rent expense to increase? Well, we do the same thing as its normal balance, like signs add, debit. By how much? $1,200. And the journal entry falls out from that analysis. This analysis says that we must debit rent expense for $1,200 and credit cash for $1,200. And when we write our journal entries, we always list our debit accounts first, then the credit accounts for that journal entry. So we're going to start out with writing rent expense. Debit, $1,200. And we're going to credit cash, $1,200. And then a quick words about what the transaction is. So we paid current month rent. And if I knew that this was January, I would say I paid January rent. So we've written a journal entry to record this business transaction. Paid $1,200 for current month's rent. We debited rent expense for $1,200 and we credited cash for $1,200. Let's do the last one. Bought a used automobile to be used in the business for $22,500 cash. What two accounts are involved? Well, how about automobiles? And cash. Let's take automobiles vertically. What kind of an account is an automobile? That's an asset account. What's the normal balance of all asset accounts, including automobiles? Hopefully you know by now, without peeking at dead coil, that it's got a normal debit balance. Did the balance decrease or increase? Well, before we bought this automobile, we didn't have any automobiles recorded on the books. Now we have an automobile to record on the books, so the balance is going to increase. Should we debit or credit the account? We want to increase an asset account that has a normal debit balance. Therefore, like signs add, we have to debit the account. By how much? $22,500. Let's do cash. Cash is an asset with a normal debit balance. We spent cash, so the balance in cash decreased. How do we get cash to decrease? It's got a normal debit balance. Opposite sign subtract. So to get the account balance to decrease, we're going to credit the account. By how much? $22,500. Let's write the journal entry. I'll give you a moment to go ahead and write it. Remember, write your debits first, followed by your credits, and make sure you indent the account title for the credit just a little bit. So hopefully you debited automobiles by $22,500 and you credited cash for $22,500. And a brief explanation. Purchased used automobile. And in the real world, I'd know whether that was a Chevrolet or a Ford Focus or a Toyota. So I would put down the actual make of the automobile. In case we have several cars, then I would know how much we paid for the Toyota versus the Chevrolet. So those are the 3 journal entries for those business transactions. The next thing you do, all the journal entries are written in the general journal, and the next thing you do from the general journal is to post each debit and each credit to its proper account. So if we look at cash, we debited cash in this transaction for $15,000. In the general ledger, we would debit cash for $15,000. And we credited J. Smith Capital for $15,000. And in this transaction, we debited rent expense and credited cash for $1,200. Credit cash, debit rent expense, and in the final transaction, we debited automobiles and credited cash. So that's just taking what we did in Chapter 3 a tiny step further. We did the same analysis. We posted the T accounts, but what we did in between was to write a journal entry. In the next video lecture, we'll do some more practice using an actual journal page and an actual ledger page. See you next time.